Hey guys, and welcome back to the channel. It's been a minute since I recorded a video. I've just been so busy with life in general. So I thought this would be a good time to go through the changes that happened in the public portfolio, because there have been a lot in the past month and a half. And I think it's a good time to go through those and see where I've allocated or removed capital to move it around and put it into higher quality, higher conviction bets in the public portfolio. So if you like this content, please like and subscribe, and I will get into this portfolio update. Now here you can see I've pulled up my portfolio. I used Fiscal AI to pull it together, and I have 5 highly concentrated bets. And you know, the way I invest, I do highly concentrated bets, high conviction, high compounding rates, things like that. So these 5 companies, I believe, are perfectly suited for my strategy, for my portfolio. Of course, it's not going to work for everybody, but in my investment thesis and thesis for all these companies, this works really well. So I'm going to go through some of these companies, and we're going to understand why I allocated capital to these. First off, I want to say that I have not touched my HCC position, my Warrior Met Coal. I've left the share count exactly the same, so that if you see the percentage changing from a previous video, that is not it. The position hasn't changed. It's just other allocations and other things that have changed. So my Warrior Met Coal, I have no changes in that thesis. The Blue Creek mine is complete, and now they're going to ramp up production to the nameplate capacity, which is 13 14 million tons, maybe more, maybe less, depending on how fast and how hard they push that mine. But that is happening, that is finished, and now their capex is going to come down and their production is going to go up. So that only means more free cash flows for the company, since they're not a tech growth company. They're not going to spend on capex for data centers or something crazy. So that money will flow right down to the bottom line, as much as it can, and be returned to shareholders. And HCC is, I think they're just straddling between, buybacks and dividends, but they're leaning more on the dividend side. So I think in the latter half of this year, 2026, we're going to see, special dividends come out, and those will be, sizable based on how much production they have, how much selling they can do into the market. They want to oversupply the market and bring down prices. That's not what they want to do. So we'll see what those numbers look like and what those special dividends look like. And on top of that, the cherry on top of that would be buybacks to reduce that 52, 51 million share count down further. So that's where I am at with Warrior Met Coal. I think nothing has changed materially in the narrative or the moat or the thesis of that company. Next, we have Google, and Google is a little interesting for me. So I did change the allocation for Google because I saw several other opportunities, and my Google position had run over 100%. It was maybe like 150% up. So I did trim my Google position by half, and you can see that it's still 25.9% of the portfolio. So that money that I allocated, that money that I took out from Google, I allocated into several other companies, and it has provided a massive return on those other companies that I allocated to. But you have to think, at a $4+ trillion market cap, Google has, if you're looking to aggressively grow your portfolio, for it to grow even double, because their share buybacks are pretty much not going to change the needle, big market cap tech names, to just have a double in the price, you're going to have like an $8 trillion market cap. And that's just not that realistic in any shorter term mind frame. So like if you're looking at 1 to 3 years, 3 to 5 years, it may happen. I'm not saying it can't happen, but it's harder and harder due to the law of large numbers to get from 4 trillion to 8 trillion or 10 trillion. It's going to be hard. They would have to ramp up their revenues and their operating margins and so many other things just to get a minute increase in that market cap. But at the same time, what are we seeing? We're seeing increasing capex. So that was the other part of the story why I trimmed it. All of these big mega cap tech names are increasing their capex into a ridiculous amount. They're doing it so much that they are taking on debt onto their balance sheet. And so at that point, I knew that, you're not going to see a double. You might not even see an increase. You might see a decrease. Once a company starts taking on debt, once it starts becoming asset heavy, that's going to be a problem for years to come, because once you have an asset heavy company, you have depreciation, you have so much on the balance sheet that is not favorable to the company. And so for those reasons, I trimmed my Google in half to use that money elsewhere. And I don't do that lightly. I think Google is an amazing company. It has so many different verticals that it can tap into. So I do keep a sizable portion in my portfolio, as you can see, 25.9%. But that money, that was a sizable amount of money that I could use in very high performing, high compounding companies like the ones I'm going to mention right now. So the new ones that you see here, AMR and Celsius Holdings, which is a drink company, those are new to my portfolio, and that's where a lot of the money I took out from Google went into. AMR, let's start with that, because that's, it's in the met coal space like Warrior Met Coal. But the torque on these shares and this company is so much more than HCC. It's a lot riskier because of where it sits on the cost curve. It's much higher on cost curve than Warrior Met Coal, which is not favorable, but their share count is dwindling fast, and the management has really dedicated themselves to doing shareholder returns only through buybacks. So they have reduced their outstanding share count by 33% over 4 years. The last 4 years, they've reduced their share count again by 32%. And now that is an insane reduction, an insane commitment to the shareholders by reducing their outstanding float that much. Now, if they continue in this fashion, when met coal can sustain a $200, $250, $300 per short ton price, they will be posting $500 to $1 billion cash flows, and they'll be able to return that directly to shareholders by doing buybacks. And that is the most flexible form of shareholder return, capital return to shareholders that a company can do. It's better than dividends. So I saw this, and I'm anticipating a turn in the met coal market, a sustained baseline of over $200 per short ton in met coal due to the Indian demand in 2029 and beyond. So I think there's going to be a sizable change in the met coal and steel markets around 2028, 2029, in anticipation of Indian steel demand coming to the forefront. So based on those narratives, I took a nice size position in AMR. I took about a 20% by portfolio weight size in my portfolio. And I think this has the potential to do a phenomenal multi-bagger. Not financial advice, obviously. None of this is financial advice. But I see this as a potential multi-bagger in years to come. And this is a long-term hold. This maybe 5 to 10 years. I'm not talking about any time short-term. It's actually going down short-term because of the news around, their DTA terminal being damaged. So we don't even have any news on that yet. But I'm hoping that this doesn't completely eliminate their ability to send coal out to their customers, but it does hamper it a little bit. So I'm waiting on the news to see how long it'll take to fix, what are the costs associated with that. So the numbers for the next quarter, the next earnings report, will probably take a hit, but obviously this is a 5 to 10 year hold for me, and I believe in the long term that this company will do amazing if the met coal and steel markets stabilize and grow from here, which I do anticipate. So I'm looking for a nice multi-bagger out of this, and I'm very optimistic with this company. So moving on, the Celsius Holdings is another new holding for me, and I also took a nice sizable portion using my Google profits into Celsius. And here, well, I have a 15.3% allocation to it, and it's already paying off. I got in around 28, I believe, as my cost basis. And right now, I think it's at 23, 22, $23 per share. So I'm already up a lot on this position. And here, the thesis is I see it as a high growth company. It's different from AMR and actually all these other companies on this portfolio. As I see it as a high growth company, I could see this going to 100 plus in the next year or two based on international expansion. So the real story here is international expansion. When they are able to get their drinks, and they're already started, they're already in several European countries. When they get this really, streamlined with their PepsiCo distribution in international markets, they are going to grow hand over foot. Their revenue numbers are going to grow, their earnings are going to grow. If they can streamline their operations even more using this distribution method, they're going to bring up their operating margins and gross margins. So I see this as a high growth company that's been really discounted. It was, the highs were at $100, I believe. So I don't see any problem of this company going back to those highs and maybe even going to new highs with the international expansion. And it's already rewarding me. Grow, it's going to compound. And this could be a, I would say 1 to 3 year hold for me. Obviously not financial advice, but that's just my opinion on this company and the growth avenues and vectors that I see for it. And then finally, I have Meta. Meta's been in my account. I haven't added any to it because I see it's increasing its capex like nobody's business, but it doesn't have a cloud unit to offset those capex numbers. It makes an amazing amount of money from its advertising business, which is the majority of it, but it's worrisome when that's the only part that can withstand this, insane amount of capex. Now, they did recently say that they're going to sell excess compute to customers, so that's a really game changer news, and that may change if I allocate some money from going forward into it. But I am still concerned about those high capex numbers. So it's kind of a wait and see for me. I think Mark Zuckerberg is doing something right in selling that excess compute. By him saying that, we really have to be careful in seeing if that's a top for some of the other companies in the market, like, SanDisk or Micron and things like that, and other semiconductor companies. Because if he's saying that there's excess compute, that means that some of these hyperscalers may need to be dialing back on their purchases, which is good for the hyperscalers, but it may not be good for the AI trade overall. For these semiconductors, for these memory plays, that might lead to a nice drop in those names. So we have to be careful in what we wish for. If somebody has both hyperscalers and semis and micro and memory plays in their portfolio, they may see an increase in the hyperscalers and then a decrease in the semiconductor and memory plays going forward. So kind of offsets each other. One is a customer of the other. So if one is spending less, the other one gets hit in their revenues. But yeah, that's my portfolio holdings right now as of this moment. I did look at some other companies that I will probably go through in my research platform, do a valuation analysis on them now that I'm back. But for right now, these are my strongest conviction plays. For Meta, also, if it does fall below $500, I would probably start buying it. If it starts dropping to 500, 400, if they do something like increase the capex even more after this, I think they allotted 145 billion this year, and if they go above that for some reason, I think that the stock will get hit. And when it gets hit like that, I probably would start nibbling it down. Not to catch a falling knife, but I think at that point, mathematically, they cannot continue to increase after that without taking on an insane amount of debt. And I don't even know if there would be possible to do that. So I would pick up some more shares of this if it dropped further. And I am looking at it very closely. So that's it, guys. I just want to get a quick video out on my portfolio structure. Nowadays, I have a barbell approach with tech, and cyclical commodities. As I continue to grow and evolve this portfolio, hopefully for high growth and eventually dividends in the coming years, I will keep you up to date on this portfolio. And as always, I'll keep making some videos on individual stock analysis and valuations going forward, and on my investor platform on Substack. So if you like this content, please like and subscribe, and I'll see you guys in the next one.